Let me know whether you are there. I want us to start. Are you there? Good. I can see a good number is already in, and we should be starting. Welcome for today's session. Okay, I can see a good number is in. I want us to continue from where we left yesterday so that at least we can finish this topic. But I was thinking if we could start with a question, it would be much better. I want you to open a question in May 2024, question 2. May 2024, question number 2. We look at one or two questions, then we can proceed. That is May 2024, question number 2. Let me know when you are ready. Let me know when you've seen it. Open the question so that we can look at it together, and let me know once you are there. You have the question. Are you there? Do you have the question? Let me see whether you have the question. Once you open the question, when you access the question, let me know. Have you seen the question? Please let me know. If you are there, I think we can go continue. Please let me know. Download those questions if you don't have them from the website. They are all on the website. That is ICPAL website. Please, for those who do not have, you will get them on the ICPAL website. If you are there, allow me to get to the question. This is May 2024, question number 2. This is question number 2, that is section B. If you are there, we can read through the question together. Is my screen visible, please? Let me know before I read so that at least we can move together. Is my screen visible? Let me know whether my screen is visible so before I start reading. Is my screen visible? Good. I can see someone says yes, it is visible. I can see someone says it is visible. Thank you. I want to read through the question. Question number B, that is section B. Question number 2. The question is Virunga Partners Limited. The question reads, Virunga Partners Limited is a private equity company headquartered in Rwanda with a mandate to manage Impact Africa Fund that invest in equity investment with the special consideration of economic social governance, that is ESG factor. During the recent investment committee meeting, a deal team member presented a potential deal that was sourced while attending an annual CEO forum held in Tunis in March 2022. The project is called Habaran by Atrust Investment Limited. The committee expressed concern over the project performance in recent years, which has been below expectation. However, one director informed the committee that from the experience, the low performance is temporary, and the company will benefit from the presented deal. The following are the key highlights of the project Harbor. Governance structure. During the assessment of governance, the deal team has identified that the company's chair of the board has been the CEO over 20 years. The company organogram shows that there are 3 chartered accountants working in logistics, marketing, and human resource department, respectively. However, the chief accountant is expected to have a bachelor's degree in engineering with over 5 years of experience in finance. Business development and marketing department. The company has no research and development department. However, the CFO, who has background in accounting, is the one who is responsible for analyzing and proposing development and initiative needed in company, but he has never presented a market study that shows gap in the market that the company should address. The marketing department focuses on TV and radio advertisement, but has never done a market survey to analyze whether customers' needs are being satisfied by the company. Working capital management. The CFO has presented that the company keep good working relation with its suppliers through paying them on time and never exceed 15 days. CFO mentioned that to maintain good relationship with the customers, the company offered 90 days credit, a policy that has been applied for over 15 years. He, however, mentioned that the company sometimes has difficulty in its working capital that require them to use overdraft facility that are very expensive compared to its normal cost of capital. Compliance. The company's CEO has revealed that the company is compliant with all applicable rules and regulations. When asked how the company reports its suspected non-compliance with the tax laws, the CEO responded that the company hired a tax consultant who has helped the company to categorize its revenue system. On advice of the hired tax consultant, a significant portion of the revenue is invoiced in the names of goods that are either VAT zero rated or exempt, when those names are totally different from the actual categories of goods required. A. Discuss 6 potential symptoms of corporate failure that Virunga Partners Limited deals team should consider if they decide investing in Project Harbor. 12 marks. The following information has been extracted from the financial statement of Azera Limited, statement of profit or loss. We are given the currency in Rwandan francs, sales revenue, cost of sales, good, raw material, labor, gross profit, administration and distribution cost, profit before interest and taxes. The statement of financial position, current assets, we've got inventory of raw material, inventory of finished goods, trade receivables, cash and bank. Current liabilities are trade payables, overdraft and other expenses. Muhoza Limited, a factoring company, has offered to take over Aheza's debt administration and credit control on a non-recourse basis for an annual fee of 2% of the sales. This would save Aheza Limited Rwandan francs 160,000 per year in administration cost and reduce bad debt from 0.5% of the sales to nil. Muhoza would reduce trade receivables day to 40 days and would advance 75% of the invoice debt at an interest rate of 10% per annum. Muhoza Limited finances working capital from an overdraft at 8% required. B1. Discuss ways in which Aheza could improve the management of its receivables. 2. Using information given, assess whether Aheza should accept the factor service offered by Powell. What use should the company make of any finances provided by the factor? C. Discuss two indicators that may show when a company is in danger of overtrading. That is question number 2. We will start with the first part. A. I will give you 2 minutes to read. Let me give you 2 minutes to read Aaron so that you internalize the question as I look at it, as I work on it, please. 2 minutes starts now. Read through the question. Okay, I believe you have read through the question, and the turnover today is too small. It seems like people are not prepared for Friday classes, but the examiner will examine everything, including what is covered on Friday. I want us to look at the first part of the question, and as I explain the question, I just want to highlight it to brush through it again. Virunga Partners Limited is a private equity company headquartered in Rwanda with a mandate to manage Impact Africa Fund that invests in equity instruments with the special consideration of economic, social governance factor. During the recent investment committee meeting, a deal team member presented a potential deal that was sourced while attending an annual CEO forum held in Tunis in March 2022. The project is called Habaran for the Trust Investment Limited. The committee expressed concern over the project's performance in the recent year, which has been below expectation. However, one director informed the committee that from the experience, the raw performance is temporary and the company will benefit from the present deal. The following are the key highlights of the project Harbor. Governance. During the assessment of governance, the deal team has identified that the company's chair of the board has been a CEO over 20 years. That is a weakness. CEO over 20 years. The company's organogram shows that there are 3 chartered accountants working in logistics, marketing, and human resource department. That is another problem. Accountants working in logistics, marketing, and human resource department. However, the chief accountant is expected to have a bachelor's degree in engineering with over 5 years of experience in finance. We are talking of an engineer is the accountant. That is another challenge. Then we talk of the business development and marketing department. Just allow me 1 second, I check on some. Sorry for the interference. For the business development and marketing department, the company has no research and development department. However, the CFO who has background in accounting is the one who is responsible for analyzing and proposing development initiative. Now you see another challenge there, initiative needed in the company, but he has never presented a marketing study that shows a gap in the market that the company should address. The marketing department focuses on TV and radio advertisement, but has never done a marketing survey to analyze whether customers' needs are being satisfied by the company. You see, that's another long placement of the employee. Working capital management. The CFO has presented that the company keeps good working relation with its suppliers through paying them on time and never exceeding 15 days. Payment in time, that's okay. CFO mentioned that to maintain good relationship with the customers, the company offered 90 days credit, a policy that has been applied for the over 15 years. He, however, mentioned that the company sometimes has difficulty in its working capital that require them to use overdraft facility that are very expensive compared to its normal cost of capital. Now, these people pay within 15 days, but they are paid over 90 days. During 90, they have a credit period of 90 days. That is another problem. The compliance. The company CEO has revealed that the company is compliant with all applicable rules and regulations. When asked how the company reports its suspected non-compliance with the tax laws, the CEO responded that the company hired a tax consultant who has helped the company to categorize its revenue system. On advice of the hired tax consultant, a significant portion of the revenue is invoiced in the names of goods that are either VAT zero rated or exempt, When these names are totally different from the actual categories of goods, that is another problem in compliance. Required. Discuss 6 potential symptoms of corporate failure that Virunga Partners Limited team should consider if they decide investing in Project Harbor. That is actually from what we have read, you can extract the possible corporate failures, and I want us to discuss as I display my part. Let me display so that we can move fast. I want to display. Always make sure that you read the question more than once to understand, and that will help you a lot when you are responding to the question. Always read more than once. That is why I am reading again and again. And as I explain my findings, I needed to see whether someone has a question, but there isn't. The question is, what are the 6 potential symptoms of corporate failure that Virunga Property Limited deal team should consider if they decide investing in Project Harbor? Number 1, weak corporate governance structure. As I highlighted, the weakness comes with the chair of the board has been the CEO for over 20 years. You note that. What is the issue here? This lack of separation. Remember, CEO is the board chair. This lack of separation between ownership and management reduces board independence. It increases entrenchment risk and can lead to poor strategic decision without adequate checks and balances, a common precursor to corporate failure. That is weakness number 1 that I identified as I highlighted when I was reading the question. Number 2, misalignment of skills in key position. I also highlighted this. The chief accountant is required to have bachelor's degree in engineering. What is the issue here? Misalignment between law requirement and qualification indicate poor HR policies and weak internal control. Financial management by unqualified personnel exposes the company to the reporting errors, compliance risk, and financial mismanagement, all of which are potential drivers of failure. That is number 2. Number 3, we talk of absence of research and development capability. Remember, the research and development is put under the CFO. So the symptom, no dedicated research and development department, and the CFO with an accounting background handles business development without market studies. So you wonder how it happened. What is the issue here? Lack of research and development and market analysis limit innovation, adaptability, and competitive risking obsolescence in dynamic market. The firms failing to identify customer needs and market gaps are prone to revenue decline. The other issue we need to note is poor working capital. As I mentioned again, they offer 90 days customer credit while they pay the supplier in 15 days. This is one of the causes of insufficient funding of working capital. So leading to frequent reliance on expensive overdraft. What is the issue here? The mismanagement in receivables and payables cycle create liquidity strain, increasing financial costs, and may lead to insolvency if situation persists, especially during the sales downturns. Another point is the unethical or non-compliance tax practices. I highlighted this when I was reading. Misclassification of good for VAT purpose on advice of the tax consultant. A tax consultant that tells them to classify items that are vatable to exempt and zero rated. So this indicates deliberate tax avoidance or evasion, exposing the company to severe penalties, back taxes, legal liabilities, reputational damage, and potential business closure if regulator enforce compliance. The other point that I noted is that over reliance on management optimism despite poor performance. With all the poor performance that we have, the management is still optimistic. The company has underperformed in recent years, but directors assume that it is temporary without data-backed turnaround strategy. What is the issue? The management overconfidence without addressing fundamental operational, financial, and strategic weakness signals inability to adapt or implement corrective action, leading to further deterioration and overhaul failure. These are the points that I would suggest. The presentation is not an issue. The issue is, do you understand the question when you read multiple times? That is the first part of that question. Let us go back to the question. We see what is in the second part. Let us see what is in the part 2. Okay, the second part we read. Okay. Yeah. The following information has been extracted from the financial statement of HESA Limited, statement of profit or loss extract, sales, cost of sales, raw material, labor, gross profit, administration cost, profit before interest and taxes 1460, statement of financial position, we have current assets, inventory of raw material, inventory of finished goods, trade receivables, cash at bank. We have the current liabilities is trade payables, overdraft, and other expenses. Then, yeah, that is an extract. We are told that Muhoza Limited, a factor, Muhoza Limited, a factor company, has offered to take over AHESA debt administration and credit control on an recourse basis for an annual fee of 2% of the sales. This would save AHESA Limited Rwandan francs 160,000 per year in administration cost and reduce the bad debt from 0.5% of the sales to zero. Muhoza would reduce trade receivables days to 40 and would advance 75% of the invoice debt at an interest rate of 10%. Muhoza Limited finances working capital from an overdraft at 8%. Required: 1. Discuss ways in which AHESA could improve the management of the receivables. 2. Using information given, assess whether AHESA should accept the factor services offered by Powell. What use should the company make of any finance provided by the factor? C. Discuss 2 indicators that may show when company is in danger of overtrading. I'll give 1 minute. Read through it 1 minute so that we can work on it together. Please, 1 minute. Let us try to answer to that question together. We see what would be expected of us in an examination. I want to display my suggestion so that we can discuss. Okay, let me check. Someone has a question. Part 1 on CEO have problem, how the shareholders lack of independence. I don't understand, but if the chairman is the CEO, the chairman is from the shareholders, and he is the CEO. I don't know whether that is what you're asking. The management should be independent of the shareholders. I hope that is the question that you're asking. That's what I feel. Someone is asking which past paper. It is May 2024. May 2024, question 2. Okay, let's look at this question together. Having read through it together, what are the ways in which AHESA could improve the management of its receivables? Remember, the receivables are current assets to an entity. One thing that they should consider is have an effective credit control policies. How should they control their credit? Number 1, set clear credit terms and limit for each customer based on credit worthiness. They should know when they are dealing with the customer, when are they expected to pay. They should review and monitor customer account regularly to identify overdue balances early. This is where we talk of you implement a software that will help you manage the receivables and which will signal you anytime that you are not doing in accordance or that there is overdue receivables. The other one is offer early payment discount. To manage the cash flow, they should encourage customers to pay early by offering small cash discount for immediate payment. This will help them on liquidity. Sometimes firms offer cash discount, meaning the earlier you pay, you will get a discount. The other thing is improve invoicing and correction process. Every time a transaction is carried out, the invoice should be sent immediately so that the customer knows how much they are supposed to pay and the term of payment. So send invoices promptly and follow up on payment systematically through reminder calls or emails. The other one is to engage factors or discounting of the invoice. We discussed about factoring and invoicing area. Factor receivables to obtain immediate cash and transfer credit risk to the factor, or that enhances working capital efficiency because the factor will take the responsibility of correcting the receivables. The other one is to perform rigorous credit checks. They should always assess the customers, the financial strength before extending credit to reduce default risk and bad debt. Those are some of the arguments that we could have for this firm on the customers so as to manage the trade receivables. If there is no question, we can move to the other part. Let me check whether someone has asked a question. Okay, I don't see any question. Now, the other part of the question, I want us to revisit. At the very bottom, we are told that Muhoza Limited, a factoring company, has offered to take over AHESA, debt administration and credit control on a non-recourse basis for an annual fee of 2% of the sales. The factor will be paid 2% of all the sales. This would save AHESA Limited 160,000 per year on administration, meaning if they continue administering or managing the receivables, they spend 160. We are also told that it will also reduce the bad debt from 0.5% of the sales to 0. So this company will be saved on administration cost of 160,000 and 5% of the sales in form of bad debt. We are further told that Muhoza would reduce trade receivables day to 40 days and would advance 75% of the invoice debt at an interest rate of 10%. Muhoza Limited finances working capital from an overdraft. So they will be advanced a debt on invoice at 10%. They are currently paying an overdraft of 8%. So the question is, using the information given, assess whether AHESA should accept the factoring service offered by Powell. What use should the company make of any finance provided by the factor? Let's try to work on it together. Assessment of the factoring. So what comes with the factoring? Costs and the current policy. Currently, they finance the receivables with 8% bank overdraft. That 8% is a cost to the firm. It is a cost to the firm. How are we going to achieve this, to determine this? If go back to the question, there is a balance sheet, a statement of financial position somewhere. Trade receivables is 1538. 1538. They are paying 8% overdraft on receivables. That is why I have taken 8% multiplied by 1538 to determine the overdraft cost that they are currently incurring. Number two, we are told about the bad debt. This company is incurring an additional cost of the bad debt, and we need to find out. We are told that the current bad debt is 5% of the sales. Can someone give me, the sales is 12,000. Can someone give me 0.5% of 12,000? 0.5% of 12,000? The sales are 12,000. In the question, we are told that the factor will reduce bad debt from 0.5% to 0, meaning currently they are incurring 0.5% of the bad debt on the sales. Can someone tell me how much is that? Yeah, 60. I can see someone has written 60. Let me just put it here so that you can use it when you are revising. 0.5% multiplied by 12. The 12 is sales. 12 is the sales. That is 60. Currently, this company is spending 60 in bad debt and 123 in financing the receivables. In total, annual cost is 183. They got 183. Let us go to number 2. When they bring in the factor, what benefits come with the factor? Number 1, new average correction period is 40. Annual sales remain at 12. So the receivables will be 40 out of 365 days per annum. You multiply by sales, the receivables will average at 13 18. Remember, it was initially 1538, but because of the new arrangement, the factor will reduce the receivables to 1318. Now, what are the finance costs of the factor? Number one, the factor comes in with 75% of receivables financed by the factor at 10%, meaning the factor will advance a loan of 75% of the receivables and will charge 10%. So the factor will charge 98.63. He will advance money. He will give like the advance. You receive money in advance. Number two, the finance cost of the balance via normal overdraft. Currently, the company is paying, or the remaining, the company is paying, is financing receivables at 8%. So if the factor will provide financing of 75%, what about the remaining 25%? They will be financed using a bank overdraft at 8%, which is 26.3. Then the administration cost, we are told that after the factor has come in, the company will save 160 Rwandan francs because it will no longer incur the administration costs. Then the factor charges. If we go back to the question, we are told that, let me go back to that part of the question. We are told that a factor company has offered to take over Aheza's debt administration and credit control on an recourse basis for an annual fee of 2% of sales. So there is the money that will be paid to the factor. I can put it here, 2% multiplied by 12,000 sales. Can someone confirm that it is 240? So the factor will bring in his cost, or will be paid 240 per annum. Let us do the analysis of what happened. Number one, the factor will be paid finance cost of 98. The bank overdraft will be paid of 26.3. The factor fee is 240, but the company will save 160. The total cost of the factor is 204, and as a result, we compare with the current policy. We determine the current policy is charging 183. So if you compare the factor, the cost of factoring is higher. It is 204, while the current policy, it is 183. The difference of 21, meaning that factoring is more expensive, and therefore the firm should not go ahead to engage the services of the factor. If someone has a question, you can ask. Yeah, someone is asking about the 25%. That is a good question. Bad debt is 0.5%. Yeah, I think that is what I said. Did I say 6% or 0.5? Okay, whichever. I think I said 0.5. Oh, so the question that comes, someone is asking about this 25%. I want you to go back to the question. Look at the question so that at least we can understand. Just read that part so that I can explain it. It is clearly stating that Muhoza Limited, a factor company, has offered to take Aheza's debt administration and credit control on non-recourse basis for an annual fee of 2% of sales. This would save Aheza Limited 160,000 per year in administration cost and reduce the bad debt from 0.5% of sales to zero. Muhoza would reduce trade receivable days to 40 and would advance 75% of the invoice debtors. That means the receivables will be financed by the factor up to 75%. The factor will give the money to this company, 75% of the receivables, to finance the receivables. That means the company will look for money to finance the remaining 25% of the receivables. And that is what we are saying, 25% of the receivables will be financed from the bank overdraft. But under the current arrangement, all the receivables are financed using bank overdraft. But when this factor come in, he will finance 25% using, he will finance 75%. The company will only borrow 25% of the receivables. I think that is the question that I had seen someone asking, and that is what I have explained. Someone is asking whether we assume all sales are on credit. We haven't been told whether there is any sale that is being sold in cash. So the assumption is that all sales are on credit. The examiner would have told us what is sold in cash. Because there isn't, it means that all sales are on credit. All sales are on credit unless otherwise stated. Are we together? Let us continue. The question was, there is that part B. What use should the company make of any finance provided by the factor? This finance that will be provided by the factor, what use can the company put that finance? Remember, they will finance the working capital. Simply, that finance will be used on the working capital, because if you sold on credit, you have the cash, you can finance the working capital. You can pay the suppliers, or you can put that money in some other short-term investment to generate more income. But you say that it is not viable to engage the factor. The last part of the question, discuss two indicators that may show when a company is in danger of overtrading. A company is overtrading. We said earlier in another lesson, overtrading occurs when the business tries to support an excessive level of trading activity with inadequate long-term capital resources. It is doing too much too fast with insufficient equity base, leading to cash flow problem despite potential good profit. A company overtrading may fail to generate enough cash to pay debts as they fall due, resulting in a liquidity crisis. What are the symptoms? What are the indicators of overtrading? Number one, rapid increase in sales without adequate working capital. Sales is increasing, you are not increasing working capital. Sales revenue increases quickly. The business expands operation aggressively without strengthening its capital base to finance additional inventories and receivables, and the liquidity crisis arise because cash tied up in operation exceeds the cash generated. That is number one. Number two, significant increase in current and non-current assets. We have large increase in stock and trade receivables. Inventory and receivables turnover slow down. You got more of the working capital, but the turnover goes down. Assets are held longer without realizing cash. Then the rate of increase in this asset exceeds the rate of increase in sales, worsening working capital pressure. The other indicator is minimum increase in equity capital. That is, the company does not inject sufficient new equity through retained earnings or new shares. The expansion is financed mainly through external credit, creating an imbalanced capital structure. The other one is high current liability relative to current assets. You got more current liabilities than the current assets, as may indicated by cash ratio, quick ratio, or the current ratio. So heavy reliance on short-term financing such as trade payables, that is creditors payment period increase the company delay payment. You have a lot of bank overdraft, overreaching or exceeding approved limit indicating cash deficit. And the other point we could say, deterioration of the liquidity ratio. We got the current ratio goes down. That shows you got more of current liabilities than current assets. The quick ratio is affected. Then possible liquidity deficit. You don't have enough to pay the maturing financial obligation. The increase in total assets funded by credit instead of owner's capital. Also, we talk of the decrease in proportion of assets financed by owner's equity, increasing financial risk. Those are the issues that we would be required to explain in that question, which I believe is good for answering such a question. One thing that I want to insist, for you to succeed in these questions, in the structured questions, read the question multiple times. Read through the question multiple times. It will help you because in case studies, the answers are in the question. Good. Now, I want to introduce the next item, but I thought it was wise if we could also answer question 3. It also relates to what we are still doing. Let me share question 3. Let me share question 3 so that at least we can work together. Just let me share this question. Good. So I don't know whether you, okay, sorry. It is not displaying. Can you confirm that you can see the question? Please, can you confirm whether you can see the question? Do you see the question? Good. If we can see the question, I want to read through this question so that we can work on it together. The question reads, Butare PLC is a major international company with its head office in Kenya. Its shares and bonds are quoted on a major international stock exchange. Butare PLC is evaluating the potential for investing in an area in which it has not previously been involved. This investment will require Rwandan francs 900 billion to purchase premises and equipment and provide working capital. Extract from the most recent, that is 2023 Statement of Financial Position of Butare PLC, as shown below. We are given non-current assets, current assets, equity, share capital, whose par value is 100, retained earnings, non-current liabilities, 10% secured bond repayable at par, which is payable in 2028, current liabilities, total equity and liabilities. Current share price is 500, while the bond price, whose par value is 100, is 105. The equity beta factor is 1.2. Butare PLC proposes to finance the 900 billion Rwandan francs investment with a combination of debt and equity as follows: 390 billion Rwandan francs in debt paying interest at 9.5% per annum, secured on the new premises and repayable in 2028. 2. 510 billion in equity via rights issue. A discount of 15% on the current share price is likely. A major positive NPV, a marginally positive NPV of the proposed investment has been calculated using the discounting rate of 15%. This is the entity's cost of equity plus a small premium, a rate judged to reflect the risk of this venture. The chief executive of Butare PLC thinks this is too marginal and it's doubtful whether the investment should go ahead. However, there is some disagreement among the directors about how this project was evaluated, particularly about the discounting rate. Director A's argument suggests that entity's current weighted average cost of capital is more appropriate. Director B suggests that calculating a discount rate using data from Kirisimbi Rwanda PLC, a quoted entity, the main competitor in the new business area, relevant data for this entity is as follows. 1. Share in issue is Rwandan francs 600 billion with the par value of 100 Rwandan francs, currently quoted at 560 Rwandan francs each. 2. Debt outstanding is 525 billion Rwandan francs, valued rate bank loan. Number 3, the equity beta is 1.6. Other relevant information. 1. The risk-free rate is estimated at 5% per annum and the return on the market is 12% per annum. These rates are not expected to change in the foreseeable future. Butare PLC pays corporate tax rate at 30%, and this rate is not expected to change in the foreseeable future. 3. Issue costs should be ignored. Required. A. Calculate the weighted average cost of capital of Butare PLC. B. Calculate a project-specific cost of equity for the new investment. C. Discuss the view of the two directors. D. Discuss whether financial management theory suggests that Butare PLC can reduce its WACC to a minimum level. That is a total of 25 marks. This is a good question, and as I said, always read through the question more than once, because once you understand it, it will be easy for you. This is a long question, so I want to give you 5 minutes. 5 minutes, read through it again, please. Read through it again so that you can understand, please. Just take your time to read through it. Good. I want us to look at this question, but maybe I can check whether someone has asked a question so that we can continue. Someone asked, is non-recourse asset a symptom of overtrading? No, is current asset a symptom of overtrading? Yes, if you hold non-current assets, if you bought land with all your money, you rack the money to finance stock, then you'll be overtrading. You'll be overtrading. Yeah, you can hold non-current asset. Overinvestment in non-current asset can lead to overtrading. It could be a symptom. Or the other person asked, the factor was, I believe it is, if the factor was with recourse, will cost increase. The first thing is to understand what is non-recourse and what is recourse. With non-recourse means the factor will take all the risks associated with the receivables, like the bad debt. So there is no way these risks will go to the farm. They are carried by the factor. So if it is with the recourse, then it means the farm will be at risk of carrying bad debt in future. That is what it means. Back to the question. This question, as we see, is a little lengthy. I want to read through it again. You would rather spend 75% of your time reading and understanding the question. You answer in 25% of the time and do it right. That spend 25% of your time reading the question because you want to read fast and finish, then you end up answering the question longly. That is why I insist again, always read this question through these questions more than once. I want to read. Butare PLC is a major international company with its head office in Kenya. Its shares and board are quoted on a major international stock exchange. The company is evaluating the potential of investing in an area which it has not previously been involved. The investment will require 900 billion Rwandan francs to purchase premises and equipment and provide working capital. Extract from the most recent 2023 Statement of Financial Position of Butare PLC as shown below. We are given non-current assets. The current assets, equity is share capital, retained earnings, non-current liabilities. There is 10% secured bond repayable in year 2028 at par. Current liabilities, the current share price is 500, bond price is 105, equity beta is 1.2. Butare PLC proposes to finance the 900 billion Rwandan francs investment with a combination of debt and equity as follows. 390 from debt at 9.5% interest per annum. They are secured on the new premises and repayable in 2028. 510 billion in equity via rights issue, a discount of 15% of the current share price is likely. A marginal positive NPV of the proposed investment has been calculated using discount rate of 15%. This is the entity's cost of equity plus a small premium, a rate judgment to reflect the risk of the venture. The chief executive of Butare PLC think this is too marginal and is doubtful whether the investment should go ahead. However, there is some disagreement among the directors about how this project was evaluated, particularly about the discount rate used. Director A suggests the entity's current weighted average cost of capital is more appropriate. Director B suggests calculating a discount rate using data from Kirisimbi Rwanda PLC, a quoted company, the main competitor in the new business area. Relevant data for this entity is as follows. Share in issue is 600 billion with a par value of 100 Rwandan francs, currently quoted at 560. Debt outstanding is 525 billion, variable rate bank loan. Equity beta is 1.6 for this company. Other relevant information, number one, the risk-free rate is estimated at 5% per annum, and the return on the market is 12% per annum. These rates are not expected to change in the foreseeable future. Two, Butare PLC pays corporate tax at 30%, and this rate is not expected to change in the foreseeable future. Three, issue costs should be ignored. Required, calculate the current weighted average cost of capital of Butare PLC. Let me share my argument so that we can discuss. Is my screen visible? That is May 2024, question number 3. Number A, we are required to determine the WACC of Butare PLC. What information do we have about Butare PLC? From the information that we're given, let's see whether if we adapted the data about this company, it will be of help to us. Look at this part of the question. We are told that the current share price is 500, bond price is 105, equity beta is 1.2. So we already have the equity beta of 1.2. Can someone spot the risk-free rate? We got the risk-free rate. Where is this risk-free rate? Can someone tell me which paragraph is the risk? Oh yeah, other relevant information. The risk-free rate is estimated at 5% per annum, and the return on the market is 12% per annum. So we are saying that risk-free rate is 5%, beta is 1.2, and we have the return of the market at 12%. The cost of equity for this company using capital asset pricing model would be given by cost of equity is equal to risk-free rate. Maybe I can just have it here. Cost of equity is equal to risk-free rate. We add the beta of equity, the beta factor of equity. We multiply by the return of the market minus the risk-free rate, like that. So that is how we are getting the 13%, the cost of equity using capital asset pricing model. I want to explain the cost of the debt. Let us first go to the debt. Go back to the question. Let's see what information we have about the debt. Current share price, the bond market. Okay, look at this. Look at this. Oh, sorry, I'm not displaying the question. But the question reads, current share price is 500, bond price is 105, but the par value is 100. That's the information about the bond. But we are also told that the bond will be redeemed in 2028. And the financial statement that you are given, we are told that extract from the most recent 2023 statement of financial position. So if the 2023 has just ended, if it has just ended, it means we are starting year 2020, 2024. So we got the period that is after. Now we need to establish how much is the cost of debt. I don't know whether you know this formula. The cost of debt, we call it yield to maturity or the current yield. The yield to maturity is equal to, we have the what I call the INT. This is the interest. Interest per unit of bond. We have MV. This one I'll take it as the maturity value. Maturity or redemption value or redemption value. Maturity or the redemption value. What I call the VD. This one is the market value of the bond or the debt. Market value of the bond or the market value of the debt. N, this one is the number of years to maturity. Number of years to maturity. And these are the variables that we have here. The annual interest rate is 10%. The annual interest is 10. Redemption value is 100. The market value is 105. So if you are to put this in the formula, the year to maturity from 2025 is 3 years. If you are to put this into the formula, we will take yield to maturity as 10. We multiply by maturity value minus the current market, multiply by 1 over 3. 1 over 3 is 1 over n, over maturity value plus value of the debt divided by 2. Can someone confirm that this is correct, please, before I explain the next point? Can someone put this in the calculator and you confirm whether it is correct? Please put that in the calculator. Let me see what is the answer from your calculator to confirm whether my calculation is correct. YTM is yield to maturity, and where I have written it in bracket, it is yield to maturity. It is the cost of capital for redeemable bonds. How much is it? How much is it? How much is it? For those asking to write yield to maturity, it's here. I have already written it. It is already written there. Can you confirm that it is 8.8% so that I can confirm whether my calculation is correct? Someone gives 0.1138. Well, now, can you confirm, please? Can you confirm, please, so that how much are you getting? There's someone who is asking whether the bond interest is 9% or 10%, 9.5 or it is 10. And did I see someone asking that? Okay, I need to answer. One, someone is asking, is interest 10% or 9.5%? The question is, we are told 10% secured bonds repayable at par in 2028. 10% secured bond. That is the one in the capital structure. It is not the one to issue. It is the one in the capital structure. So it is 10%. I understand where your 9% is coming from. Another one is asking, but we have been recommended to use IRR when calculating cost of debt when we are given small period of years. Okay, I know okay. Either way, is there any difference? If you cram from the answers, you will want me to do what is in the answers. I am using the way that you can understand it easy. So I know where you got that one from. I don't copy my computation from the answers. I do the calculation. As long as they give us the same answer with a difference in loading, I think I should not copy the answers. I do my own calculation. So either of the methods is okay. But when you say we are recommended, I don't see anywhere in this question where we are recommended the method to use. What I know is that you had checked the answer, you are checking the answer, and you want me to follow what is in the answer. So the computations, did someone compute? Oh, you are giving me so many different answers. Which one is correct? 9.7, 8.1, 8.13, 9.7, 11.38. So please, can we confirm? Can we get this? Try to put it in the light way, please. Let us Can you confirm the number of years? I have seen someone asking and I've noted. The statement reads, the statement here reads, extract from the most recent 2023 statement of the financial position of Butare PLC are shown below. So if it is the 2023, then it means we have 24, 5, 6, 7. That is, oh, did I make a mistake? Where did I get the 2025 from? Butare proposes to finance investment with a combination of debt and equity as follows. They intend to make the investment immediately. So those are not 3 years, right? N is 5 years. N is 5 years because the redemption is at the end of these 5 years. This is from 2024. The redemption will be in 2028. So I think that one I made a mistake. Can you give it 5, 5, 5, 5? Please confirm this one for me. 10 plus 100 minus 105. Then you divide by the average of 100 and 102. How much is that? Let's do it fast. Let's try to be a retro fast. I had made a typing error here. So how much is it? How much is it? N is 5 years. N is 5 years, not 4 years. If the redemption is 2028, the assumption is at the end of 2028. There's someone who is giving 8.8, 10.7. Make sure that you do the right thing. You put the right figures in your calculator. 8.8, 8.78. So 8.8 we agree. 8.8. Now, the yield to maturity is before subjecting it to taxation. Then we say that after tax cost of debt, we multiply by 1 minus tax, and this one is giving me 5.67%, if you can confirm that. So we have now the cost of debt and we have the cost of equity. The next thing is to determine the value of each. The value of each. Let us start with the equity market value. From that question, there is somewhere we are given equity. We are told that share capital of 100 Rwandan francs, which is 450 billion. 450 billion. Then down there, we are told that the share price is 500. That means we are supposed to take 450 divided by 100 multiplied by 500. That is how we are getting to 2250. The value of equity, the market value of equity. The market value of debt, the same thing. We got our equity. Let's go back to the question. We are given 10% secured bond payable at par. In 2028, they are 1,800. they are 1800. We need to determine how much is the value. If the par value, down there we are told that bond price whose par value is 100, the market price is 108, 105, 105, sorry. So we can put it this way. Let me put it well so that at least we can understand it. Let me put it in the best way. This one might confuse someone. It is par value divided by 100. We multiply by the market value of 105. Confirm whether it is 1890. Now, if that is the case, the weighted average cost of capital is the equity of a total value plus multiplied by the cost of equity plus debt over total value times the cost of debt. So equity value is 2250, debt value is 1890, the total value is 2250 plus 1890. Therefore, the weighted average cost of capital is 2250 equity over the total value times cost of equity plus the value of debt over total value plus multiplied by the cost of debt. Can you confirm for me that this one is giving us 9.88%? Please confirm that. Confirm that. Confirm. I can see someone confirmed the value of the debt. Our computation of the cost of debt, we computed the cost of debt here. This was the cost of debt, unless I think someone is asking whether it is the one 5.67 and it is the one that I have used here, the cost of the debt. Can you confirm that WACC is 9.88? 9.88. Someone says there is an error in the cost of debt. Okay. Can you confirm for me that whether my computation for the cost of debt is correct? Please, please, please do that. Cost of the debt, cost of the debt. Can you confirm that 8.8 multiplied by 1 minus 0.3 is correct? I think it is 6 point something. 6 point 6.14, I think so. 6.14, 6.15. Yeah, that one is correct. 6.15. 6.15, 6.15. Like that. So can you give me the WACC then? Give me the WACC. I hope everything else is correct. How much is the WACC? 6.16, 6.15. I think it ranges there. 6.16. Yeah, majority says 6.16. Okay, can you give me the WACC? WACC. How much is the weighted average cost of capital? 10.1, someone says 10.19. Someone says 10. Can you give it at least to 2 decimal places or at least 1 decimal place? How much are you getting? 10.09? 10.09. So we make it 10.09 or 10.1. 10.09, 10.01. That which is okay, that one is acceptable. 10.09%. 10.09%. That is the weighted average cost of capital for the current capital structure. The next question was, calculate a project-specific cost of equity for the new investment. Now we are on the project. We are on the project. We are told that Butare intend to undertake the new project. So we need to compute the cost of this project. Let me display it. The project, remember, we borrowed a lot of information to the Rwandan company called Kilisimbi. If we are given the beta factor, the risk-free rate remains, the return of the market remains. So what is the beta factor for this company called? We are told that Director B suggests calculating a discount rate using data from Kilisimbi Rwanda PLC accounted entity, the main competitor in the new business area. Relevant data for this entity is as follows: shares in issue, debt outstanding, equity beta is 1.6. We go by the Director B argument. We will take the beta factor of 1.6. Everything else is the same. Can you confirm for me that these figures are correct? Just confirm for me, please. How much is it? How much is this cost of equity for Kilisimbi? $16.2, $16.2. $16.2. Yeah, you see, someone says it is correct. So 16.2%. That is the next question. What is the other question that you are required to respond to? Discuss the views of the two directors. Let's see, what is the view? Director one suggests the entity. Okay, we are told that this is the entity's cost of equity plus a small premium at a rate. Okay, the chief executive of Butare PLC think that this is too marginal and is doubtful whether the investment should go ahead. However, there is some disagreement among the directors about how the project was evaluated, particularly about the discount rate used. Director A suggests the entity's WACC was more appropriate. Director B suggests calculating a discount rate using data from Kilisimbi Rwanda PLC, a quoted entity, the main competitor in the new business area. Then we have the other information. So that one is the reflection of the industry in Rwanda. Now let's try to look at this. Discuss the views of the two directors. Director A suggests using current WACC. This one we calculated it and I had given 9, so it is 10.09%. WACC reflect average risk of the existing operation. If project has similar risk profile to existing business, WACC is appropriate. However, if the project risk differ significantly, using WACC may understate or overstate the true cost. That is what we would say. Director A wants WACC, but the question is, does the WACC reflect the risk of the new investment? For Director B, he suggests using the project-specific cost of capital of 16.2%. So adjust for risk-specific. Remember, we are using a beta factor that is specific, then more aligned with the pure play approach in capital budgeting. Then it ensures that project returns are benchmarked to its actual risk, avoiding incorrect acceptance or rejection. That means Director B gives much better argument. So for a new business area, Director B's approach is theoretically superior, ensuring investment decisions reflect project-specific risk, enhancing shareholders' value. That is what I would argue. Number B, or the last part of the question. Discuss whether financial management theory suggests that Butare PLC can reduce its WACC to a minimum level. The theory is about including debt in the capital structure reduces the WACC. Can Butare PLC reduce its WACC to minimum? According to theory with the taxes, increasing debt initially reduces WACC due to tax shield. However, excessive use of debt increases financial risk and the cost of equity due to high financial distress risk. There exists an optimal capital structure beyond which WACC starts to increase. You remember we said a decrease in WACC, but it will start increasing with huge risk, with huge debt. You can reduce it to the optimal level. So in conclusion, we say that Butare PLC can reduce its WACC to a minimum by optimizing its debt to equity mix, but cannot reduce it indefinitely. That says there is a point where if you go beyond, the WACC will start to increase. And that is what the question required. We have tried to answer that question to the best that we could. At least today we've solved 2 questions. Yeah, so that is it. I want us to wind up this topic, but is someone asking a question? There's someone who is concerned about the marks. Okay, this answer regarding specific cost of equity is incorrect. We should go through the process of regearing beta factor, because the business risk is different. But we are told that a comparable company, for non-listed companies, we use comparable entities in the market. For this one, we are going by the, what do we call it? A comparable entity of equivalent risk. And that is why the examiner gave you and told you that there is a company in Rwanda. If you look at that statement, There's somewhere we are told that about Kirisimbi something. Where was it? Yeah, Director B suggests calculating a discounting rate using data from Kirisimbi. Why do you need to re-gear and yet you are told to use the Kirisimbi data? A quoted company, the main competitor in the new business area, relevant data for this entity is as follows. We are just told to use an equivalent company that is listed in Rwanda. So we cannot change anything. It will not be prudent to change anything because it is a suggestion by the director. Use it. Use the one for that company. I want us to wind up this topic. I'm winding it up in a few minutes. I want to explain few ratios that may be relevant in capital structure. If you can see my screen, I want to explain. Financial and operational gearing. Financial and operational gearing. Financial gearing or the financial leverage refers to using debt to increase the amount of assets a firm control. You borrow to buy assets. This allows owners to operate with more resources than if they used only their equity. That is borrowing, going for long-term borrowing. The question that will be asked is, what is the degree of financial gearing? This is a ratio that the examiner will tell you to compute. Degree of financial gearing is given by the percentage change in earnings per share over the percentage change in earnings before interest and tax. How much did the earnings per share increase or decrease? How much did the earnings before interest and tax increase or decrease? That you express it as a percentage, it will give you what we call the degree of financial gearing. The degree of financial gearing indicates how sensitive a firm EPS is to the change in the earnings before interest and tax. When the earnings before interest and tax change, how sensitive is the when we change the earnings before interest and tax, how sensitive, how will the EPS change? That is financial gearing. Then we have the operating gearing. This relates to the proportion of fixed operating costs. The operating cost in the firm, the rent, salaries, other administrative expenses. It measures how change in sales lead to change in earnings before interest and taxes. And we say that the degree of operating gearing is equal to percentage change in earnings before interest and tax over percentage change in sales. So let me put this one well. Degree of operating gearing. Operating gearing. Degree of operating gearing. So we have the degree of operating gearing. It is given by the percentage change. Let me put it correct this way. The percentage change in earnings before interest and tax divided by the percentage change in sales revenue. That is degree of operating gearing. So It measures the sensitivity or vulnerability of earnings before interest and tax to change in sales. It can also be used to measure business risk. If the degree of operating gearing is more than 1, then the business is operationally geared. The gearing is too high. Now, the two gearing, operating gearing and financial gearing, will give us the total gearing. If you're told to give the total gearing, you take the two. So we say that under this one, what we call the total gearing, a firm's total gearing combines both financial and operating gearing. Degree of total gearing is given by the degree of operating gearing times degree of financial gearing. Always remember this. The degree of total gearing is the product of degree of operating gearing and degree of financing gearing. This shows the overall impact of sales changes in earnings available to shareholders. And that is the ratio. Now, I want us to do this. I want us to do something here. Let me put it. Let us go to the two formulas. Let me copy the two formulas. Degree of financial gearing. I want to have it here. Degree of financial gearing. I want to give degree of total gearing is equal to the degree of financial gearing, like that. We multiply by the degree of operating gearing. Let me pick this one here. The degree of operating gearing. So I'll take this, multiply by, I'll pick this, like that. Then I'll pick this one and I'll have it there. So we can have it this way. The percentage change in earnings per share multiplied by percentage change in earnings before interest and tax divided by percentage change in earnings before interest and tax times percentage change in sales. Can we therefore say that if we removed this, I wanted to strike through. If we cancel that against this one, against this one, against that one, then it means we'll have a different formula. You'll have a different formula here. We've said that we strike this, then we strike this. Can we conclude the degree of total gearing is percentage change in earnings per share over the percentage change in sales. That is what it means, and that is what I had given down here, but I've realized I had not explained like that. That way, that is the degree of total gearing. So therefore, it measures the sensitivity or vulnerability of earnings per share to change in company sales. That is what I needed to explain, and I think I have expounded it in the very right way. Unless someone has a question, I am done with that topic. I want us to move to the next topic. We should be starting a new topic. Oh, before we start a new topic, there is something else that I had added to wind up here. Yeah. Just remembered. I wanted to explain something on dividend theory, dividend policy. And there are a few items, but let me see whether someone has a question. Okay, let me wind up by taking this part of the dividend policy. The dividend policy of an organization is very critical because it helps to determine when to pay, why to pay, how to pay, and who to pay the dividends. When setting dividend policy, a company must consider several practical and strategical factors. The factors to be considered when paying dividend, number one, is the issue to do with the taxation. Shareholders with a high income tax rate may prefer low dividend to avoid heavy taxes. Those people with a lot of money, they don't like to be paid dividend because they don't like to pay taxes. They know that when you pay them dividend, they will pay tax. But when you reinvest, no tax is paid. Those with low or zero tax rate may prefer high dividend. The trade-off between income tax versus capital gain tax influences performance. Taxation is a major issue to do with payment or setting dividend policy. It depends on who your shareholders are. Two, investment opportunities, what we call the residual theory. If there are more investment opportunity and the company is growing, the firm will pay less dividend. That is, retained earnings to finance all profitable investments, pay any remaining profit as dividend. The challenge with this is that dividend may fluctuate significantly year to year based on investment need. There are years like investors, shareholders may not be certain about what dividend they will earn because investment change from time to time. The other one is availability of finance. If the firm has a lot of debt, it will pay debt to avoid paying dividend. We say that highly geared companies may need to retain earnings to strengthen their equity base and reduce gearing. When you pay less dividend, you increase the equity. For small or unquoted companies lacking access to external finance, they will also retain more dividend. Firm without collateral to borrow will retain more earnings instead of paying dividend. The other issue is liquidity. There are cases where the firm may be profitable without cash flow. If the firm is profitable without cash flow, it will not pay dividend in form of cash. That is how to pay. If the firm has cash flow and it is not profitable, again, it should not pay dividend because of cash flow, it should pay on profit. So profit does not equal cash flow. Adequate cash flow is needed to pay dividend, fund capital investment, especially for growth companies. The next item is cost of new finance. If paying dividend will make the company to borrow at a high cost, the company may rather not pay dividend. The other thing is the transaction costs. We say that shareholders who rely on dividend may find homemade dividends, that is, selling shares to generate cash, inconvenient and costly due to brokerage fee. The transaction cost of buying and selling shares can sometimes be too costly for the firm, and therefore the shareholders will retain their shares in the company or their investment in the company, hence earning dividend. The other thing is control of the firm. Paying high dividend may force a company to issue new shares for future financing need. This risk dilution or control. A company that pays more dividend does not have enough to invest. It will resort into issuing new shares in the future. This will affect the current shareholders. The other issue is to do with inflation. Company may need to retain earnings to maintain operational capacity during inflation. When there is inflation, you need more money. The company may prefer to retain dividend so as to finance operation. Shareholders seek higher dividends to preserve purchasing power. So there is a conflict during inflation between company and shareholder, because shareholder need more money, but the company needs to retain more. The other thing is information content. We say that dividend signals company's current performance and future prospect to market. A company that pays dividend, it is signal information of stability that can attract more value to its share. So change in dividend often impact the share price. The other thing is about the issue to do with existing debt. We called in our earlier discussion restrictive bond covenant. I remember talking about that yesterday. A restrictive bond covenant. You may want to pay dividend, but you are restricted by the bond covenant. That is another factor that affects the policy of a company to pay dividend. The other one is legal restriction. In most cases, the company that are listed in stock exchange, and I will give an example of Nairobi Securities Exchange. Any company that is listed cannot pay more than 70% of its earning as dividend. That is a legal restriction. You can find out what is the restriction in Rwanda. Maybe if someone knows what is the restriction in Rwanda, I think you can tell us. The other one is what you call the perceived risk. We say that a bird in hand is better than two in the bush. Some shareholders say, let me have my money. I don't want to be promised the future growth of the company. That is another factor that you'll consider in setting dividend policy. The other one is stability of dividends. Company with gradual increase in performance will pay dividends that are increasing. And the other one is the issue to do with the constant payout ratio. A company may adopt a constant payout ratio like 40% of the earnings. If it operates like that, it means that dividends are paid based on performance, and they will change with the change in profitability. And that is the end of that topic. I think we've discussed a lot because we had that topic yesterday, and we also had that topic last week. It has consumed a lot of time. I want us to move to the next topic. The next topic, we need a break. We haven't taken a break. Before we get to the new topic, can you take a 5-minute break? 5-minute break. We take the break. We'll be back to continue from there. You can take some water or coffee. Yes, can you hear me? Let me know whether you are there. We continue. So let us pick on another topic. And our next topic is financial risk management. We'll be looking at the various risks that faces a firm, but we need to understand the trading in the forex market or the foreign exchange trading. So I'll start with foreign exchange and international trade. The one thing that we need to look at when we talk of the international trade is to understand the term exchange rate. Exchange rate, we say that it is the rate at which the currency of one country exchange with another country. Example, we can talk of 1 USD is 150 shillings, Kenya shillings. We can talk of 1 USD is equal to 1,500 or 1,500 Rwandan francs. Rwandan francs. So the exchange rate, the rate at which the currency of one country are exchanged with those of another country. Then we have what you call the forex market, foreign exchange market, forex market. It is a market where currencies are traded, where currencies are exchanged. We talk of global market where currencies are traded. Main dealing centers, we have the London Foreign Exchange, the New York, the Tokyo Forex Market. The participants in the Forex are banks, the central banks and government entities. Some currencies are not freely traded due to exchange control exposed by the government. There is that trading in the market that is given freely, and there are those that are controlled. So Forex is the market where currencies are traded. Then we talk of the exchange rate system. We got different systems for the exchange rates. The first one is what you call the fixed exchange rate. We say it is maintained by the government using official reserves, such as the foreign currency or the gold, where the government will maintain a certain exchange rate by issuing and withdrawing the foreign currency from the market. So these exchange rates, when they are fixed, they are based on variables like gold, or they may be based on major currencies like the USD, or they may be based on bracket of currencies, a combination of currencies. The advantage of this one is that it removes uncertainty and it encourages trends. But now its limitation is that it limits domestic economic policy independence. Like the exchange rate is not freely in the market. That is what we call the fixed exchange rate. The next one, we talk of floating exchange rate. This is where you leave the currency exchange rate to be determined by forces of demand and supply in the market. There is no intervention, the government just leave them to float. So it can be free floating, no intervention, or managed floating, where occasional government intervention comes in. Then we have its advantage is that it reflects the true position of the market for a country. Its disadvantage is that wide fluctuation creates trade uncertainty, especially if a country has issues, it can fluctuate, causing uncertainty. And the third one is what we call the adjustable peg or the movable peg, where fixed rate with provisions for devaluation, revaluation to correct persistent balance of payment, deficit, or surplus. Like they are the adjustment, the government keep on controlling. It may rebate to control, sometimes it rebate to trade freely, but there is that balances. So it offer more flexible than strict fixed system, but it still constrain policy choices. Those are the way the market can be looked at when it comes to the forex. I don't know whether there's a question to that point. Any question to that point? Or someone was saying that he could not hear me. I hope you've checked your mic. Yeah, you advised to check your mic. Oh, someone is asking what was the number one. I wanted to put number one, the introduction. And that is why I skipped it. I wanted to just give the introduction. Okay. Let me see on the chat box. Okay. The factors to consider in the international trade. Let us continue. Factors to consider in the international trade. There are the issues of risks that you find in the international trade. We can consider the various types of risks. One, we can talk of the risk type, credit risk. Higher default risk in foreign trade mitigated via export credit insurance or letter of credit. When you are selling to external parties or you are buying from external parties, there is that risk that you may not be paid. Then we have the physical risk. When you are importing goods, like when importing goods through the port of Mombasa, there are risks that the goods may be lost in transit, or they may be lost from the country of origin, they may be lost at the point of destiny. There are those physical risks. We've had issues of piracy, the pirates hijacking ships in the deep seas. You see, those are physical risks. So we say that good lost, damaged, or stolen in transit, mitigated by commercial insurance. All goods in transit overseas, they are insured to cater for physical risk. The other one is exchange control. Sometimes the exchange is not left to the forces of demand and supply, they are controlled. As a result of that, they affect the fund transfer. The other one is foreign laws and custom, different legal systems and business practice, the the taxation, like the one that was introduced this year by Donald Trump against the country he felt were competitive to America, those ones will affect many people who are trading in foreign trade. The other one is the issue of taxation, varying tax rates, potential double taxation, where you are taxed in one country and you are taxed again in another country. Like the VAT, you could be taxed VAT in all the countries that you are dealing with. Especially VAT is very common because if I am importing goods from Rwanda, I will come and buy the goods from Rwanda, I'll pay VAT. Then at the point of entry, the Kenyan government will require me to pay the VAT. So you find that there is the issue of taxation, and they sometimes lead to double taxation. The other thing is political risk. The government action, we got the issues of politics. You are importing, like what we experienced in Russia, the political issues in Russia. We've had issues in Turkey. No, okay, not much in Turkey. Not in Turkey. There is this other country. The issue of political instability. The other one is the issue to do with exchange rate risk. We'll be looking at the exchange rate risk to try and understand how are these risks. There is transaction risk, translation risk, and there is the economic risk. We'll be looking at that. We will also be looking at the way to hedge them, the way to prevent them. As we say, there are forward contract hedge, option contract hedge, swaps, money market hedge, for the matching contract, the matching hedge. We will be looking at all that. So those are the risks that faces the traders in the forex market. Then we look at the methods of overseas expansion. When it comes to trading overseas, number one, we exporting. If you have the spare capacity of production, you can export goods. So you use the spare capacity to produce, like what America does. All that they produce may not consumed in America. So they end up exporting. This one lead to high transport costs, there are tariff quotas, maybe less reliable service and support. Then you talk of the foreign direct investment. You identify new market and you go and invest there. So the foreign direct investment leads to new market, economies of scale. You avoid tariffs, diversification, cheap labor. You can go to invest in a country where you will benefit from the cheap labor. The problem is high capacity commitment and political and operational risk. When you're investing in another country, the risk is higher than when you invest in your country. Those are the challenges that are there. Then we talk of the issue to do with licensing in foreign trading. We say that their market penetration with large capital reduces political risk, avoid transport cost. There's let me see. The licensing method. The licensing method. The market penetration without large capital reduces political risk, avoid transport cost. The issue of the licensing, depending on how the country is. Like if I am exporting from Nairobi to Kigali, and we have the truck from Kenya, it will freely flow through Uganda to Kigali. If you are exporting from Kigali to Kenya, or you want to import through the port of Mombasa, you will freely send your truck from Kigali to Nairobi to Mombasa. The problem is that there are some countries like we have one of the countries like Zambia. If you send your truck to Zambia, they have currently an issue where they tell you once you get to their border, you use their drivers, the Zambian drivers. That has been a major issue because you send your truck, but they tell you to use their drivers. Yes, we still use the foreign drivers, but they give preference to their drivers. So that licensing, to get the license to operate in a foreign country, it is another major issue when it comes to forex trading. The other one is the issue to do with the joint venture. That is network shared cost risk, access to incentives, sometimes mandatory. There are countries where if I invest in your country, I am required to onboard a citizen of that country. Some other country like Kenya, you are not required. You can come invest in Kenya freely. You are not required to have a Kenyan in your company. It is not a requirement. But some other countries, you cannot go invest without onboarding the locals. So there is that issue of the joint venture. It helps the country because it creates employment, but sometimes it restricts some investors who do not want to sell their shares. So when it comes to the issue of the forex, that is the basic argument. Now I want to explain the exchange rates in foreign trading. Exchange rate in foreign trading. We say that in forex market, currencies are quoted A, directly. I decided to explain this one this way so that we can understand, all indirectly. Now I want to explain direct quote. Direct quote. We say that it is the amount of direct quote is the amount of local currency, local currency per unit of foreign currency. Direct quote, it is the amount of local currency per unit of foreign currency. For example, we talk of Rwandan francs, 1500 per unit of USD. The amount of foreign currency per unit of foreign currency, 1500 Rwandan francs per unit per single dollar. Or we can say the Rwandan francs 11 per unit of Kenya shillings. That is said to be a direct quote. If you don't understand this one, it can cause problem when it comes to trading in the forex market. Direct quote is when you say home currency to foreign currency. The amount of local currency per unit of foreign currency. The other one is indirect quote. The indirect quote, we say that it is the amount of foreign currency per unit of domestic currency. These are some of the things that causes problem when it comes to answering questions in an exam, because you need to understand what is direct quote, what is indirect quote. For example, we can say that e.g. We can talk of 0.006667 Rwandan francs. Let me no, USD 0.00067 per unit of Rwandan francs. Now, if you look at this, there is no difference between this quote. If you looked at this quote, we talked of the Rwandan francs 1500 per 1 USD. For this one, we are saying USD 0.0006667 per unit of Rwandan francs. They mean the same, but the only difference is that the first one is a direct quote, while the second one is an indirect quote. That's what it means with the direct and indirect quote, and it is always good to understand what is the meaning of that. We can also say that something like Kenya shillings 0.09091 per unit of Rwandan francs. You see, when you look at that, it doesn't have a difference with this one. It means they mean the same. The only difference is that the way they are quoted. Now, when it comes to the quoting of the currency, the currencies are quoted at spot exchange rate or forward exchange rate. What is a spot exchange rate? Spot exchange rate. We say that is the market, or let me put it this way, is the exchange rate within 2 days of trading. Within 2 days of a transaction. It is the exchange rate within 2 days of a transaction. If I made a transaction today, within 2 days, whatever the exchange rate is in the market, all that I will be given, it is said to be a spot exchange rate. Then you have the forward exchange rate. We say that is the exchange rate after 2 days of transaction. It is the exchange rate after 2 days of transaction. You should always understand direct quote, indirect quote, spot exchange rate, forward exchange rate. I don't know whether someone has a question. Oh, I have misspelled the word currency. I will correct that one. Yeah, someone is confirming that in Rwanda you have to employ a certain number of the citizens. Yeah, that is it. Someone is talking of come again on those strategies. Okay, that part, the greatest part and the one that I decided to type, this is the part that will help you, is the one that now we are on. And I would want someone to ask a question if it is not clear what is direct quote, indirect quote, the issue to do with spot exchange rate and the forward exchange rate. And I want to add something here. We say that forward exchange rate, the forward exchange rate, we say that forward exchange rate is explained from the spot exchange rate, using a discount or a premium, It is explained using a discount or a premium. We say that forward exchange rate, given the premium is equal to the spot exchange rate plus a discount, or forward exchange rate is equal to spot exchange rate minus premium. So you are told that, okay, we will learn this one when we'll be dealing with the forward. We say that in the forward exchange rate, we will be dealing with premium and discount, and the bank is the one that tells you, we will give you a discount or we will offer a premium. If you are told that we are offering a premium of 2 units, take the spot you minus premium to get the forward. If they tell you that we are offering a discount of 2 units, take the spot, add the discount to determine the forward exchange rate. That is what it means. Very important to note that, very important to understand that. Those are basic things that you need when it comes to the Forex. I don't know whether someone has a question. What do you mean within 2 days of transaction? I think I said if you did a transaction today, when does the 24 hours end? When does, okay, not necessarily 24 hours. When do the 2 days end? At the point that it ends, any exchange rate that is given after that is called forward. But if you are told that the exchange rate tomorrow is this much, that one we call it spot. Spot is exchange rate within 2 days of trading, of transaction. Whatever the exchange rate you are given within 2 days, if you asked what it is, you will say that that is a spot exchange rate. But if you are told that we will use the exchange rate on Friday next week, that one we say that we are given the forward exchange rate. I hope I have explained that. The within 2 days and without 2 days. I don't think there is any other question. So, having understood that, the issue to do with the quoting of the currency, When does the financial institution make profit or loss? We say that the difference between the quotes is known as the spread. If today you walked to your bank, the quotation will be given this way, e.g. spot exchange rate is given as we say that let me put this way, Rwandan francs to USD. This is how, when you go to the bank or the bureaus, it is quoted this way. It is given Rwandan francs 1500 to Rwandan francs 1800, 1750 or something like that. That is how the quotation is done. If you walk to any bank tomorrow and check, that is how the currencies are quoted. So the spread, the difference between these two is what we call the spread. So we can say that difference between 1500 and the 1725 is the spread. That is the spread. It is the basis for which the financial institution make profit. The difference between the two. And always currencies are quoted at a lower price and a higher price. One is buying price, the other one is selling price by the bank. If you have dollars, you take to the bank will buy your dollars. If you need dollar from the bank will sell to you the dollars. They cannot sell to you the price that they bought. That is why you are always given two prices. That difference is called the spread. I don't know whether there's any question. I don't want to exit there. I want to leave you to go through what you've done so that when we meet next time, I will deal with the serious issues. Someone is asking whether it is the current rate. The definition of current rate in Forex is 2 days. So it is the current rate. You will see in some quarters, whether books or whether online, they will tell you that spot exchange rate is the current rate. But they need to tell you what is the definition of the current, the word current. Current in Forex is within 2 days. The spread is the basis for which the company make profit. If you buy at 15 and sell at 18, that is the one that determines your profit. For the one who is asking what is the difference between, what is the use of the spread? There is someone who is asking what is the next topic, and yet the topic we haven't even done 5%. Okay, why would you be interested in the next topic and we have just started a new topic? I don't know. Someone says that you are not getting my voice. I don't know. Check on your mic. The cost of the spread is the extent to which the financial institution want to make profit. Yeah. The extent to which the financial, you see, it's like a profit margin. It is set by the financial institution, so it is not about the cost. It may be caused by forces of demand and supply, or it may be regulated by the government. Okay, so I think we can leave it at that for today. Let us take a rest. Today, the turn up was not very good. We are at 80%. Yesterday, we maintained 100%. Remind those who are not present that even what we do on Friday is still examinable. Yeah. That is the basis for which the profit is determined. It is not necessarily the profit. It is the basis for which the profit is determined. Okay, let us leave it at that. Have a good evening. See you next week. We will finish this topic, I believe, next week. I'll try. We push it on Thursday and Friday and finish. Have a great evening. Have a great evening. In class, they left. They signed in and left. So after about 10 minutes, they will be here asking, are you not teaching? Is the class still on? Like they have come from space. So for those who are in class, the class is over. Have a great evening and enjoy your weekend.